All right. Hello, everybody. I am so glad you are joining us today. My name is Vicki Maris, and I'm an assistant director at the Steyer Center for Executive Education in the Mendoza College of Business at the University of Notre Dame. This is webinar number 3 in our series of free webinars on Wednesdays at 1. I know from going through all of your names that several of you joined us for the first couple of webinars, and several of you are new to our series. I do want to let you know up front that we will be providing a link to the replay of each of these webinars. We do not have those ready yet, but I'll be sending something around to let you know when those are ready to go. The webinar today, we have 2 of our instructors from Module 2 of Certificate in Executive Management, and actually that module would have kicked off today if we had been on campus. So Professor Ed Hums and Professor Janet Otusa are in the classroom today in our webinar. They would have been teaching this class in a day-long session on the campus of the University of Notre Dame, and I'm going to do a really quick introduction in just a moment. Kalinda Hamilton is one of my coworkers on the team at the Steyer Center who is assisting. So thank you, Kalinda, for helping us with the chat today. Ed has a lot of content he is going to be sharing in this fantastic webinar. So Professor Otusa has agreed she'll be watching the chat and looking for your comments and questions, and she will likely be the one that might let Ed know if there's something where we need to take a pause and get some clarification. Other things she'll be answering for you right in the chat. We do a follow-up call on Thursday at 4 o'clock for the people who were enrolled in this module if it had taken place on campus. And we have a few extra spots open, so if this topic today really is of interest to you and you'd like to dig in a little further and have more of a conversation with your webcam turned on, that's what we'll be doing tomorrow at 4 o'clock. Just send me an email and let me know if you would like to be participating in that tomorrow. We have a few extra spots. So as I have done in the previous couple of webinars, I have gone through the list of everybody who enrolled and have spoken each of your names out loud. I have prayed over you. I'm just honored to be here with you, and I'm getting chills as I say that. Your dedication to leading your teams, to advancing your careers, to bringing all you can bring to your work and to your families. I appreciate you for doing that, and I pass along our love from the team here and all of those folks that Kalinda and Ed and Janet and I work with in the Mendoza College of Business and at the university. It's really a special place, and I wish we were all there on the campus right now, but I'm an online course designer, so I got to tell you, I'm pretty fired up that we get to do this online too. So I want to remind you to get out your notes, however you like to take notes. I want to read just a quick statistic about that. If you take notes in some format, 30 days later, you'll retain if you don't take notes, about 30 days later, you will have retained about 10% of what you experienced today. If you do take notes, you have the option of retaining about 55%. And here's my additional challenge. If you go back to something that you learned today and teach it to someone else, do a little video on your LinkedIn profile, type up a paragraph and send an email to somebody with something that you learned today, it increases your learning retention to 89%. That's my challenge to you today. I've got a slide here to show you our upcoming programs, but this is not a promotional webinar about the programs. We, of course, would love to have you with us on the campus in the future. I can send out the slides to anybody who would like a copy. And I also have bios on both Ed and Janet, so if you want to know more about their background, they are award-winning instructors in the Mendoza College of Business. Our undergrads, our grad students, and our lifelong learners in executive education love to be with them in the classroom. Ed and Janet, thank you for taking the time to do this webinar today, and you guys will both be with us next Wednesday as well, so if you're not yet registered, get registered for next Wednesday's webinar. A different topic next week, but they'll be with us again. All right. With that, Ed, I'll drive the slides for you and off we go.
Okay, I'll tell you what, Vicki, thank you very much for putting things together. Kalinda, thank you for putting things together. And most likely, what I also have to say is a big shout out to my partner, Jan O'Toole, a wonderful professor, and she's gonna do a great job today. Got to have a shout out to her. Now, I'm wearing a hat today, just to let you know. I had a little eye surgery the other day, so I have to have a little bit of a brim to cut down the glare. And so today I'm a prop in the Notre Dame Fire Department, the NDFD, and you can see some of the rigs there. Oldest continuous operation University Fire Department in the nation, founded in 1879. So 141 years of service, and we appreciate the men and women of the Notre Dame Fire Department. So I just want to kind of welcome the continuing students, anybody who's joining us for a guest. And why don't we just kind of jump in and talk a little bit about accounting. So we've got about, about 50 minutes of talk about accounting. So we'll go to the next slide and we'll take a look at accounting is the language of business. You know, you have to really kind of understand accounting. You know, I think Warren Buffett has always said, if there's any class that you want to take, any concept that you got to understand, it's accounting. So accounting is the language of business, measures business activity, processes information, communicates results to decision makers. And my friends, to some extent, I don't think it's the language of business. I think it's the foundation of all civilization. Hey, probably never heard that one before. When you think about what makes up a civilization, you think about things such as a language. You think about things like, numbers. You got to do something with your fingers. And you think about laws, how we interrelate. Now, that really is a civilization. So when you think about the foundation of a civilization, it rests on a tripod of a language, of numbers, and of laws. Perfect example of what accounting is. So if we take a look at the next slide that we're looking at, and this is kind of an earnings report, and if you've have any kind of any familiarity with me, I love to follow the rail industry. So this is an example of an earnings report for the rail industry. We're not going to go through the whole thing, but this is kind of what you would see if you were to put together an earnings report every quarter. This is what the NS would put out and publish. And really what it talks about are three things. There's only really three numbers here that they talk about that are important. And the first one is going to be, revenue. The next one is going to be net income. And the third one is going to be earnings per share. But you know, what really is revenue? What really is earnings per share? So we want to kind of talk about those terms. So one of the things we want to understand is we want to understand the terminology, which we'll do in the first part. Second part, we want to talk about the principles and concepts. So kind of think like an accountant, scary thought there. And lastly, we want to take a quick look at financial statements. So let's go a little forward here. And we want to take a look at a few of the definitions. We said we'd start off with definitions. So the first one is we want to talk about an asset. Okay, so an asset is something of economic value, of use now or in the future. Okay, something of economic resource. Doesn't mean cash, doesn't mean building. It just means some kind of resource that's available to you now or in the future. We come into liabilities, which are economic obligations. And these economic obligations are really payable to outsiders, not necessarily somebody within the organization. So we're talking about creditors, okay, folks that we owe money to. And last, we talk about owner's equity, and this is really when we take a look at the insiders. So what we have to kind of think about is for every asset that we have, think about a railway. For every asset that the railway has, like a locomotive, somebody has a claim against that locomotive. How did the railway get that locomotive? Did they go out and borrow money? Well, you got a creditor relationship now, okay? The railway borrowed money, got an asset, have a liability. Maybe it was internally generated funds, okay? So you don't necessarily have a liability, but you've got an owner's equity, something that has to do with the owner. So when we go to the next page and we talk about revenues a little bit, and so revenues are increases in assets, and really I think the key here is going to be revenues are from ongoing normal business activities. It's something that happens on a day-to-day activity. That's what we're taking a look at, all righty? So, and expenses are decreases in assets, really, or increases in liabilities for ongoing normal, again, business activities. So when we think about a revenue, an increase of an asset, it might be cash. Cash goes up, all right? Expense, cash goes down. Keep it real simple. But these are from ongoing activities. So these are from transactions that occur one after another, after another, after another, during the normal course of business on a daily basis. And then we also have kind of gains and losses. That we kind of take a look at this because these are things that happen, as I put down here, from peripheral activities. So you can have a gain on the sale of a building. Now, you're not necessarily in the business of buying and selling your business, okay? Buying and selling the building that's used for your business. You might do it every now and then. So it's really a peripheral activity because it's not an activity that's that goes on day to day. So why don't we take a look at the next slide where we're going to talk a little bit about revenue, and we want to talk about revenue recognition. And when we take a look at recognition, it's not like looking at the box. Janet disappeared in the box, but I would look in that box and say, "Hey, Janet, how you doing? I recognize Janet." That's not what we're talking about. That's not what we're talking about in revenue recognition. It's really, when do I get to record revenue? So this was a traditional definition of when could you record revenue. Delivery has occurred or service has been rendered. Evidence of a client arrangement to pay. So basically, it's not a sham transaction. Price is determined, so we actually know the price that's involved in the exchange transaction. And basically, collection is, for a lot of my friends out there, is reasonably assured. We didn't say always assured or exactly assured, but reasonable assurance, okay? And I like to kind of define it down at the bottom as doing your end of the deal. When can you get to record revenue? When you do your end of the deal. And that's very important because a lot of the transactions, a lot of the compilation of business activity revolves around when revenue is recognized. So it's basically doing your end of the deal, okay? Now, one of the things that's come around is revenue recognition has kind of been slightly altered in the recent years, is there's kind of brought into it a concept of also a contract. So you understand that between somebody who you contracts for a service and somebody provides a service, there's an agreement on how you recognize this revenue. So the fulfillment of a contract, okay? So a lot of times in the old days, let's say if Boeing was to sell an airplane, a lot of times Boeing would record revenue when the last bolt or screw was turned on the wing, let's say, okay? But what did, let's say, the airline buy? They actually bought a plane that was supposed to work. So it wasn't when the last screw was turned. It may have been now currently, you take a look at when do you deliver an airplane that works. So when you take a look at revenue, it's very important that we understand revenue. So if we look at revenue versus cash, which is the next slide, we have to kind of remember that revenue doesn't mean cash. So cash can be collected before revenue is being earned. At Notre Dame, what we have to do is we have to pay for our season football tickets. We have to pay for our season football tickets in advance. So I had to write a check for my season football tickets. I think it was in at the end of April. So Notre Dame's got my cash already. When will it be considered revenue? When Notre Dame does their end of the deal. So a lot of what you have to think about is, when is it going to be revenue? It's not when you pay. It's not when the tickets are delivered, but when you perform the service. So basically, doing your end of the deal is at kickoff. You know, I don't want to say when the game is played because I've watched too many games that really we didn't play and it wasn't that great. You know, but at kickoff, we've done our end of the deal. Cash can also be collected when revenue is earned. You can even visualize McDonald's here. You know, you buy that Big Mac and you pay for it immediately, and the cash could sometimes be collected after revenue is earned. So after revenue is earned, basically what you're going to be doing is sending a bill out to somebody who you've provided a service for, okay? So that's the difference between revenue and cash, all right? Let's take a look at maybe defining assets a little bit more. And I know I'm kind of rushing through these slides. We'll go to the next one. So we want to talk about assets. And again, economic resources that benefit an organization now or in the future. So we're taking a look at assets, and some of them can be classified as short-term versus long-term. And you're going to see that classification, and you want to think 1 year. You all think 1 year, my friends, and that's kind of the delineation mark between a current or a short-term asset. So cash, and again, cash is king. It's the medium that we use to exchange business transactions. So we want to make sure and again, it's very current, it's very liquid. You can have accounts receivable, and that's basically what people owe you. Remember, that's an asset. So the asset is the receivable, which is the claim that you have against somebody else, okay? So that's really, the receivable is an asset, and hopefully you can collect it within the next year. That's why we would call it a short-term asset, and maybe inventory. Now, inventory can be either merchandise that you're going to sell, or it can be something, materials and supplies that you will consume. But again, most likely that's going to happen within a 1-year time frame, okay? And then we can take a look at maybe some of the long-term assets on the next slide. And if we go to, if we take a look at long-term assets, their traditional one is property, plant, and equipment. And if you think about what is property, plant, and equipment, property a lot of times is the land, plant is what's built on the land, like the building, and equipment is what's inside the building. So you want to record those and again, at cost. We'll talk about depreciation a little bit later. You may also have some investment accounts where you're buying stock, maybe in another company. Goodwill might be something else that's a long-term asset. And also some kinds of intangible assets that you have that are long-term. And when you think about it, something like a franchise might be an agreement that's for multiple years between you, let's say McDonald's franchise, for the right and privilege to own and operate McDonald's. The long-term asset, not necessarily the building, although the building is a long-term asset. The long-term asset is the franchise agreement. And it may only be a piece of paper there that recognizes it, but it's a long-term agreement over time. So you can have assets that are short-term, and you can have assets that are long-term. Again, these are economic resources. So if we want to go over and take a look at liabilities now, and liabilities, again, same concept. They can either be current liabilities or they can be long-term liabilities. Current liabilities, how about some accounts payable? You know, these are the bills that you come up with, let's say the normal course of business, buying things for your goods or services for resale. Accrued expenses could be interest payable, salary payable, those kinds of, anything that's a payable. And again, it's payable within a year. So if I take a look at income taxes payable, yeah, you probably should pay your taxes within the year. That's probably a good idea. Short-term borrowings, letter of credit types of relationships, but also the current portion of long-term debt. You see where this comes into play, and I for many years I had an opportunity to work in the financial area of the university and putting together financial statements and running their audits, doing their taxes. And one of the things that we would find is that you always the current portion of long-term debt is considered a current liability. Because that amount, let's say if you do a 30-year borrowing, say you do a 30-year mortgage, what you really have is 1 year of short-term debt, 29 years long-term. The next year, what do you got? 1 year short-term, 28 years of long-term, okay? So you want to show that portion of the debt that's payable within the next year, even if it's a long-term debt, within current liabilities. And what that will do is really provide a little bit more information to the person of interest that, let's say, a lender or a creditor or somebody who's going to lend you money or extend you credit, they want to know about what your commitments are. So current portion of long-term debt. Now we can go over to kind of some of the longer-term liabilities, things like mortgages, unsecured notes, bonds, things like that if you were to issue bonds. Deferred income taxes, so differences in accounting methods here. And you know, something that seems to be really a topic that has a lot of interest now are things like pension and post-retirement obligations. And for a lot of us, you know, a pension is basically what somebody will pay us in our retirement. And it can either be, let's say, a defined contribution plan or a defined benefit plan. And they'll pay us. But also you have post-retirement obligations. So what might that be? So not a pension, but there's going to be commitments that the university would make to me when I retire someday, hopefully. And it might be things like maybe I'll get my 20% discount at the bookstore. I got that going for me in retirement. Or maybe I get 10% off of my season football tickets. That's all well and good, but maybe it's going to be the Notre Dame's contribution to my health insurance as a retiree. No, that's not a pension. That's a post-retirement benefit obligation, okay? So if we flip the page and go on to the next slide, we're going to be talking about owner's equity. And again, here we're talking now about anything that's not committed to a liability of an organization. So here's your assets, and you want to subtract out all the liabilities, all the commitments that you have to outsiders, to creditors. Anything that's left over is kind of something that the owners would have a claim against, all right? So you've got some common stock, could be part of that. And we have some definitions of shares that can be authorized, issued, or outstanding. Maybe we'll talk about this on Thursday a little bit. Paid in capital, some treasury stock, and treasury stock has to do with stock buybacks. And then retained earnings. And retained earnings is really kind of the balancing account of what's left after everything happens. Retained earnings, okay, is going to be the account that you would put all the net income that you earned throughout the year. You're going to close it out to retained earnings at the end of the year. And out of retained earnings comes dividends. So dividends come from retained earnings. And again, maybe we'll talk a little bit more about this on Thursday or tomorrow when we meet. So we kind of zip through a lot of the definitions, just so that we kind of had an understanding of what's what. And so then we take a look at an accounting result. So net income, net loss, pretty straightforward, you know, revenues versus expenses. But lastly, earnings per share. When we take a look at earnings per share, what is the net income that we had as an organization, or the net income that we had, or the net loss that we had? But we want to divide it by the number of shares that are outstanding. Now, the number of shares that are outstanding are the number of shares that right now exist in the marketplace that investors hold, okay, outside the organization. And we want to take a look at this as really, what is the earnings, what is the dollars that we have earned for each share? What's available for each share? And what you want to compare that to is the earnings per share actually becomes a source, or maybe a guideline for what are the amount of dividends that could be paid. Let's say we have $1 earnings per share this year. How much dividends will we declare? Will we declare 20 cents dividends for every quarter, so 80 cents in dividends? We earned $1 a share, but we're going to pay 80 cents in dividends. So when you take a look at it, earnings per share, that's basically taking a look at what might be available for dividends. Okay? All right, so what do we see next? Here, I think next we're going to get into the mind of how we think as accountants. That's a scary thought, okay? But let's go forward. Some of the principles that we look at. Well, first of all, we want to take a look at something that's called accrual accounting. Now, just as a reminder, that's not C-R-U-E-L, it's not cruel. If you work with accounting a lot, you're going to think it's cruel, but it's accrual. And the foundation for the accrual accounting is you record revenue when you earn it. You record revenue when it's earned. And then you record expenses as they are incurred. And please pay attention to that word, as they are incurred, not when they are paid. Same thing with revenue. You record it when it's earned, not when you collect it. And expenses when you incur the revenue. So it's a conceptual format. Includes a couple of accounting concepts and principles, and we'll talk about those maybe a little bit now. And it's required by generally accepted accounting principles. So if you've dealt with accountants, or you've dealt with auditors, you've heard the term GAAP, generally accepted accounting principles. And these really kind of define the field of play. What's acceptable? What's acceptable? What are the ways that you can record revenue? What are the ways that you record an expense? And really what you take a look at is, if it is considered something that's acceptable, it's within, and I like to use the visualization of the field of play. So if you look at a football field, it's 100 yards long, 52 yards wide, and if you catch a pass and you're in bounds, all right, it's in the field of play. That's an acceptable, all right, generally accepted accounting principle. If you catch the pass out of bounds, in other words, it's something that's not an acceptable principle that you've used. You're not in the field of play. So generally accepted accounting principles are kind of a big deal. So let's go to the next slide where we talk about the revenue principle. And again, when do we record revenue? So kind of really the recording of transactions revolves around this one. I record revenue when earned, when I have done my end of the deal, when I have sold a product, when I have performed a service, when I have performed, let's say, an audit, when I've had a medical procedure done, like my eye surgery, done the deal, I get now to record revenue. Now, the next thing is the question of, well, how much revenue do I record? It's going to be basically the cash value. You know, you think about it, and you're going to go out and you want to, at some point in time, get a new vehicle. I'm looking at a Ford F-150. I have a debate in the Hums household whether I'm going to be able to get one. You know, we've got a little disagreement between my spouse and myself, and the vote's coming out 1-1, which doesn't bode well for me. But it's basically, when I'm looking at that new vehicle, I want to find out how much it cost me. I look at what's the sticker price, right? Well, guess what? Is that going to be the amount that changes hand? Is that going to be the cash value of the goods or services transferred? And the answer is going to be no, because it's going to be what I pay the Ford Motor Company or their dealer for this asset. It's the agreed upon value. It's not the sticker price. It's not what you could sell this asset for. It's not what you think of buildings it's worth as in this environment now. What you think something is worth. It's what the agreed upon dollar value is going to be, the cash value on exchange, okay? So again, when you do your end of the deal, second thing is, how do you record it, the cash value? So if we continue onward, okay, what we're looking at, we can get up a slide, matching principle. Now we're talking about expenses. So what we want to do, the matching principle talks about how do we record expenses? Well, again, we said revenue recorded when earned, expenses recorded when incurred, okay? How do we determine when an expense has been incurred? So what we want to do is kind of match up that revenue against the expense and get it in the same time period. Match that revenue, match the expense against that revenue. So if we go on to just one more slide, how might we do it? Sometimes there's a natural link, let's say a cause and effect. So sometimes you see something that's called a sales commission, alrighty, or cost of goods sold, things along that line. Or I'll give you another example. How about bad debt expense, okay? So I make a sales transaction, okay? My sales transaction is for $100,000, and I think that maybe for all these sales transactions, 1% on average will go bad, will not get collected. So I sell $100,000 on credit. I have made a sale, I earned revenue, but I have to match expenses to get it, so I should match a bad debt expense against that $100,000. Why do I have to do that? Well, I want to make sure that any expenses that is applicable for that revenue is recorded, and here's the important point, in the same time period. Okay, so I made a sale, albeit on the last day of the month. I accepted a risk on the last day of the month by making that sale that this transaction would go bad. I may have a bad debt. I have to record it in the same time period. And I have to make an estimate on that. Okay, so I have to make an estimate on that. So, you know, sometimes there's a link between revenue, natural link, to revenue, and then expenses just flow and are attached to those revenues. Sometimes it's a time period though. So you want to think about rent or salary or things like that. So that can be tied into a more like, let's say, a time period. So if you think about rent for the month of May, and then you got the rent for the month of June, rent for the month of July, on and on and on, same amount of rent. It's not necessarily tied to any revenue stream. It's probably tied to a time period. And your goal down at the bottom is to really determine what's the true cost of providing these services or these products over any period of time, okay? So what we can do is maybe sneak over to the next slide, and we'll take a look at something that's called consistency. So in the back of our minds, accountants want to be consistent. We really like consistency because we want to take a look at comparisons. If I were to take a look at, well, how did I generate revenue for this month? I'm going to say that I want to take a look at every month is going to be ending on the last day of the month. So I would take a look at month-end revenue, month-end revenue, month-end revenue for, you know, May, June, July, August. I'm not going to say that the month is going to end on the 3rd week or the 5th week. I've always ended it on the last day of the month. So I want to kind of be consistent in what I do. And so I take a look at the principles and principles and some of the things that I look at. And I want to be very consistent on how I look at it, different inventory valuation methods, because what I want to do is take a look at my organization over time. You know, I take a look at Union Pacific Railroad, and it's been around 154, I think it's like 157 years right now. Happy birthday, Union Pacific. But its existence is sliced into time periods called a year. And I want to compare year to year to year to find out how we're doing, okay, from one year to another. So that's what I want to take a look at. And the more I'm consistent in how I put together financial statements and how I record revenue and how I do my matching of expenses, it really lends itself to making those comparisons on really an appropriate method, or really a well-done comparison. Now, sometimes you have one-time events. So you may have the sale of a sale or disposal of part of a business, and we understand that. And so you want to maybe take a look at that and record it a little bit separately. And we talk about that as, you know, we do record things like unusual, infrequent, something that's infrequent or unusual. So, you know, if you change the useful life of an asset, if you change your, let's say your bad debt expense, let's say instead of 7% bad debt expense, it goes up to 8%. Maybe it goes up to 14%. I remember that when I used to run telecommunications at the university, we used to take a look at maybe 14% of our billings would go unpaid. So you always have the ability to make some kinds of changes, but you really should kind of disclose what those changes are. And that's the next slide. When we talk about the concept of disclosure, so again, accountants think about disclosure. We want to make relevant, reliable, and comparable information available to whom? Well, to owners and creditors, to our shareholders, to creditors who are people that have lent us money or extended us credit. We want to get that information out there in a really usable format that they understand. And so what I have to do is kind of disclose what my methods are that I'm using. So maybe I want to disclose my inventory valuation method. Do I use an average inventory? Do a specific identification, FIFO, LIFO? Disclose it to my creditors. What do I do for bad debt expense? What's the percentage that I use? On and on and on. So we really want to kind of get as much information as possible out there to the folks that are reading our financial statements. All right, so disclosure principle. Next one we want to take a look at, I know we're kind of zipping through these, and we want to talk about materiality. Hey, when in doubt, argue materiality with your auditor. This is not a material transaction, okay? The definition of materiality. I'll tell you what, my friends, it's hard to say what that definition really should be. What's a material transaction? I found the definition that I think I like to follow is, if the number is a material number, if the number had changed, okay, if the number had changed on a financial statement, it would have directed me to a different decision. So how much would I have paid for this company that I'm buying if I find out their inventory is undervalued by $100,000 or overvalued by $1 million? I would have paid something different, okay, if I bought this company. I would consider that material. So it's not necessarily, let's say, a percentage, maybe like a 1% difference or $1 million. You want to think about a material difference as something that would have changed the business decision. You got to remember what your audit letter looks like, okay? If you have an audit, you're going to get a letter from your auditor that says these financial statements fairly present the financial condition of this company, XYZ, in this time frame. And if I remember right, what you're going to see in all material respects. So it's going to say, it's not going to say it presents perfectly what your financial statements are, but it's going to talk about materiality, okay? In all material respects, these financial statements are fair. All right. All right, what's our next topic? Oh, conservatism. I love conservatism. Accountants really, you know, you want to put together, when you put together a financial statement for an accountant or an auditor, in the back of your mind, here's the way you really ought to take a look at this thing. Hey, I never want to overstate my assets, or I never want to overstate net income. I don't want to get into trouble down the road. If I were to sell my business and I overstated my assets, somebody may be paying too much for my business. Guess what? Somebody's going to sue me, on and on and on. I never want to overstate net income. I never want to overstate my net assets. So when I look at it, a lot of times you want to think about, you know, accounts can be, again, you want to take a look at things like being very optimistic. So you take a look at what might be optimistic. Put together a room of sales agents. My brother had he had a small steel company in Elkhart. He had a lot of sales agents, and they were the most upbeat people I ever met. You know, hey, Stevie, you make it, I'll move it. I mean, totally upbeat. You think a look at pessimistic, and that's like a room full of accountants. I'm sorry. A room full of accountants, you know, you're always like, oh, wow, we'll never make this revenue, and these expenses are understated. Oh, and man, it's not a lot of fun sometimes. And I spent my life around a lot of accountants. But what you have to do is you have to be in a situation where you're going to be realistic. You have to kind of take a look at what a real number should be. Now, we're going to talk a little bit about this, I think, in the next module that we present, which will be budgeting. And I think in budgeting, this will be a little bit more of a topic. But again, conservatism. As an accountant, you never want to overstate net assets, and you never want to overstate net income. Okay. And lastly, we talk about just kinds of adjustments on kind of to our financial statements. If you go to the next slide, we talk a little bit about adjustments. So a lot of times as your period ends, we're going to be talking about maybe some things like accruals, deferrals, and depreciation. I'm going to try this on the screen, okay, if you guys can take a look up here. An accrual, how about this? Here you go. That worked out pretty well. In other words, I'm bringing something into me. I'm bringing something into my financial statements. I'm recording some additional revenue that a transaction has not yet been recorded. Think about, I performed a service. I'm sending somebody a bill, but I performed a service in the month of May, okay? I performed a service in the month of May. I'll send a bill out in June. When did I perform the service? Month of May. When am I going to record a transaction? When the bill goes out? Yeah. But guess what? I have to make an accrual to record the revenue earned in May. Got to make that transaction. So that's a lot of times we talk about accruals. The other thing we talk about is deferrals. And we're going to try this one more time if we get a visual here. Here we go. Deferrals. Deferrals means I'm pushing out. So I've got an expense, but I want to record it in the future. It's going to be impacting. It's going to be impacting transactions in the future. So if you want to take a look maybe at revenue, and I will record that revenue into the future. I've not yet earned it. I've got it in advance. I've got a deposit from somebody. It's not revenue until I do my end of the deal, which might be next period. So I'm kind of deferring it. So this kind of explains what happens to your books. A lot of times if you have an auditor comes in or your accounting staff is looking at year-end transactions or quarter transactions or maybe even month-end transactions, that's what they're going to be looking at. And lastly, depreciation. And depreciation is a systematic allocation of the cost of a plant asset to an expense, to expense over the asset's useful life. Guys, example, rail industry. You're going to buy a locomotive and you're going to pay $2.4 million. And if you take care of your locomotive, it's going to last you for 40 years. That locomotive is not an expense of $2.4 million when you buy it. It's going to be lasting 40 years. So really, how much was an expense in that period? You want to record an expense of $60,000. In other words, 1/40 of that total. Why? Because if you didn't have that locomotive that you decided to buy and put all the money up front and pay the cash up front, you would have had to rent it. And you understand renting it, you're going to have to pay for it as an expense. Okay? So, and again, maybe we could talk a little bit about depreciation when we meet in on tomorrow. Okay? So then what we want to finish off with, folks, is we want to kind of finish off with our financial statements. So let's take a look at financial versus managerial accounting, all right? So financial accounting. And when I worked in the main building, and I spent 25 years of my career in the main building working in the financial area, financial accounting really is reporting that's to outsiders. So shareholders, and there's no shareholders in the university, but there are stakeholders, okay? So reporting to stakeholders or shareholders, or let's say reporting to creditors. We have a lot of creditors at Notre Dame. We have a lot of creditors in your business. So reporting to those outsiders, okay? So that's financial, that's really what we would call financial accounting, okay? Managerial accounting, on the other hand, is internal. Okay, managerial accounting, got top executives, department heads. And so when you're taking a look at financial accounting, you want to think financial statements, your published financial statements. And when you think managerial accounting, what you really want to take a look at is, let's say, a budget. A budget is more of an internal document for your plans. And we're going to be talking about budgeting in the next module. So stand by for that. but it's going to be more of an internal. Now, financial statements that you put together have kind of a designed order and structure to them, generally accepted accounting principles, my friend. So there's an order that's kind of expected that you present these financial statements in. Now, managerial accounting, internal documents, I mean, they have to be logical. They have to add up, but there's no really set format that you have to do, okay? Think of whatever works for your business, alrighty? So I was involved in both of these heavily, and I'll just tell you, maybe 10% of my time was on financial and 90% was on managerial, alrighty? So let's take a quick look at another slide. We want to look at the next thing, accounting principles and concepts. Again, generally accepted accounting principles. They're going to rule how these financial statements look and how we put these financial statements together. And again, we use them in the financial statements. They have to be, and if you look at the audit report, it's going to be these financial statements fairly present, whatever, you know, the balance sheet, the income statement that we'll look at real briefly, in accordance with generally accepted accounting principles, okay? So we use those in financial statements. Now, we don't use them in managerial reports, okay? Just remember, we don't use them in managerial reports. Internal documents are what works for the organization. So if we go to the next page, we're taking a look at an income statement. If I look at an income statement, geez, this looks great. So we basically divide it up into operations, and you won't go into it really. We're kind of stretched on time here. We want to take a look at operating revenue, cost of goods sold, gross margin. So again, for a retailer, gross margin's a big deal, you know, so it's basically after my expenses come in, my cost of goods sold, after my cost of goods sold come in, what's kind of the margin that I made? Because that margin has to cover all the other expenses of the organization, huh? So I keep going down, and you know, we kind of separate out things that are not really from operations, maybe interest, other. Got to have a little other in there. My friends, I'm going to call your attention to the last expense. And the last expense is always going to be income tax expense. Bottom of the financial statement, bottom of the income statement, income tax expense. And so what we wind up with is net income. So revenues minus expenses, we came up with a net income of $2,400. Now, if I had 2,000 shares outstanding, my friends, I will divide that 2,000 shares into $2,400 and come up with an earnings per share of $1.20. And my friends, there's only one ratio that has to be reported on a financial statement. That's mandatory reporting, and that is earnings per share, and it shows up on the income statement. Okay, so the income statement, pretty straightforward. Alrighty, so again, we defined what revenue was. We defined how we record expenses. Let's go on to our balance sheet. Now, if I look at my balance sheet, again, here's my assets. What are my assets? Anything of economic value, now or in the future. Got them lined up on one side. Now, I like this format here, okay? On one side of the equation, I've got all my assets listed. Here's everything that have an economic value. On the other side, my liabilities on owner's equity. So here's my assets. What are my claims against my assets, maybe by creditors or outsiders, okay? So 14,600 of current liabilities, 54,000 of long-term liabilities. That's who has a claim against that. $98,400 of assets. Of that, it looks like 68,600 are claims that outsiders have. Insiders have the difference, okay? So it can either be stock, maybe retained earnings. And again, what is retained earnings? What's left over from net income at the end of every period, okay? So if we go on to the next slide, we want to come up with probably one of the other financial statements that I think doesn't get a lot of attention, but I think if you're a small business owner or, you know, a smaller operator, this really is the king of financial statements. And when I do my analysis of investing, I always go to the cash flow statement first, because cash is king. If you run out of cash, you're sunk. I'm dead serious. You run out of cash, you're sunk. So I want to divide the cash flow statement up into three activities. First one is going to be what we call operating activities. Now, operating activities, we want to list the sources and uses of cash. So now visualize, we're just looking at what's happening to cash within this time period. We're just visualizing what's happening to cash, all right? So how does cash go up? How do I deposit? What are my payments going to be? And I want to take a look at my normal ongoing activities, day-to-day transactions. So I'm going to take a look at my day-to-day transactions, and I'm going to call that my operating activities. So on an ongoing basis, am I bringing in more cash than it's going out? Am I bringing in more cash than is going out? And that's positive. We'll call that positive cash flow. And positive from cash flow, my friends, is for operating activities, positive operating cash flow is the best barometer of the ongoing health of any organization. On a continual basis, am I bringing in more cash than I'm sending out? Day-to-day activities, all righty? Second one, investing activities. Now, when I take a look at investing activities, I want you to think long-term assets. So assets that I have, maybe long-term assets would be things like property, plant, and equipment. So land, buildings, stuff that you put inside the buildings, all your equipment, trucks, delivery vehicles, airplanes, all those sorts of things. So what we're taking a look at is those are kind of, let's say, the long-term assets that you deploy. Well, guess what? I want to see negative cash flow. And I really want to see negative cash flow. And when you think about it, well, Ed, what are you talking about? And guess what? Negative cash flow means you're planning for the future. You know, you're planning for the future. Why? You're acquiring these assets that will benefit you in the future. And you're paying for them. Your cash is going out of your hands now because you think you're going to be around and you think you got a plan in place and you're going to do great. But again, you have to acquire those resources now in order to do great in the future. So I want to see negative cash flow from from investing activities. And lastly, we talk about financing activities. And when we take a look at financing activities, we're taking a look at things like stock transactions or borrowing money. So how else does a business finance itself? Okay, either ongoing activities, day-to-day basis, but I might also have to go out there and raise cash through borrowings or issuing stock. So if we go to the next slide, which is kind of an example, a very simple, simplistic example of what a cash flow statement is, I kind of take a look at this, and then it tells me that I started the year with $1,000 in cash, and I began the year with $500 in cash. I ended it with $1,500. So my net increase in cash was $1,000. Okay, so my cash went up by $1,000 during this time period. How did it go up? Well, $4,200 was from cash flow from operations. So day-to-day activities. Now I've got net income. Okay, my earnings. I've got depreciation in there. I have to add back depreciation. My friends, you got to remember, depreciation is a non-cash expense. Depreciation is a legitimate expense that you have, but you have to add factor that back. You have to add it back. Why? Because when did the cash come out of your hands? When you bought the asset. Cash came out of your hands, let's say, in an investing activity, not in an operating activity. So you have to add that back. So I got $4,200 coming out of my hand as an increase in operating cash. I've got cash flow from investing being a negative $8,100. And when I take a look at it, I've got some things where I bought some investments, I sold some investments, and that kind of offsets each other. I've been parking some cash in investing. But also I take a look there and say, what did I do? I bought property and plant and equipment for $7,600. $7,600. That's what I bought. I spent some money planning for the future, eh? All righty. Well, guess what? My cash coming in from operations $4,200. I spent $8,100. Okay, going outflow on say investing. How did I have an increase in cash? Well, guess what, my friends? Down at the bottom, I went out there and I issued bonds. So maybe I took out bonds, I issued new bonds. Maybe I entered into a lending agreement with somebody, so a cash inflow. Maybe I have a mortgage that I entered into. So I have a lot of cash coming into my hands from a financing activity, borrowing money. And maybe I paid down some debt. So those are things that you take a look at. One last thing we want to look at is as far as dividends go. Dividends are always shown as a decrease in cash from financing, as an outflow in cash from financing. Dividends, my friends, do not show up on an income statement. there is no such thing as dividend expense. Dividends come out from retained earnings. What do we say retained earnings were? The result of all the net incomes or net losses previously of the organization, adjusted for other dividends. That's where the dividend money comes from. That's where it comes from, dividends. So last thing we take a look at, I think we have we've got maybe another slide to take a quick look at, and it's notes on financial statements. Hey, we have to have some notes because you know, you have to really kind of take a look at it. Just the numbers are they're great. They tell a story. But my friends, they don't tell the whole story. So I like to read the notes a lot of times for companies that I would consider doing a small investment in. I like to read their notes. So really, if you're taking a look at financial statements, a complete set of financial statements also includes the notes. And so the reader is assumed to be a sophisticated reader. In other words, financial statements are prepared not for the common person on the street. They're prepared for the sophisticated reader. And I'll tell you what, when I think about sophisticated reader, I think about Audrey Hepburn. You talk about sophistication. I would have said the intelligent reader, but Jan pointed out, you know, I should use a nicer term like sophisticated. And boy, that reminds me of Audrey Hepburn. So the sophisticated reader, they're prepared for who? For bankers. They're prepared for folks in the, let's say in the investment organization. That's who they're prepared for. They're not prepared for you and me. I'm sorry, they're not prepared for the man on the street. They're prepared for somebody who understands all these terms that we looked at before, and they understand how these financial statements were put together. So their first note for these financial statements always should be significant accounting policies. Always want to put that together. So how did, you know, the major classes of assets, you know, what estimates did we use? What are the accounting policies that we use? Matter of fact, even just what was the year end? We want to define that. So that's what's available for these organizations, okay? So you put things out there and you put these notes together, and it's all the detail, and it's pages and pages and pages and pages of these notes, because sometimes you have at the bottom of the slide other disclosures in detail on specific, on some kind of accounts, specific financial accounts that there may not be any activity in. And folks, there's going to be some kinds of things that you have to disclose to the readers of the financial statements that do not show up in a financial statement. It may be things like, let's say you are being sued. Okay, so you want to, maybe, and you look at generally accepted accounting principles, and they will say this kind of a suit has to be included in the notes. All right, so if you've lost a lawsuit and you're going to appeal it, but your attorney says, I don't think it's going to work, there is no financial transaction yet. There's no dollar and cent transaction. You have to kind of bring one in. Okay, you can also take, so you're going to have to record that one. But what happens if you're being sued by a bunch of folks and it hasn't been litigated yet? I mean, there's not been a decision, but you are being sued. Would that have, let's say, a substantial impact on your company? Yeah. Do you have to disclose that fact? Yeah, you have to disclose that fact. So that's going to be a transaction. That's going to be a kind of contingency that's in the notes. That's only in the notes, but it's not one that you have to record, okay? Because it's only possible that you could lose money in these. And you think about lawsuits, product liability lawsuits, you think about software kind of lawsuits, things like that. So there are a lot of things that you have to kind of include, and you have to be included in notes. So a lot of times when we talked about the notes of financial statements, we always use the term, if you want to find out where the bodies are buried and where the dirt is, go read the notes to the financial statements. So what do we got next? Our next slide. It looks like that looked like our game plan from a couple years ago for Notre Dame. So not really much of a game plan, but I want to just get Jan and I want to give you a quick thank you, because what you've done is you've given us a great gift, and really you have. You've given us a gift of your time, and I'll tell you what, it's a valuable gift. So I'm going to call it quits here, turn it over to Vicki, and believe it or not, we got through the lecture. You know, my students in the classroom would say, gee, Prof, you could have done a whole semester in accounting in, what, 1 hour? Why didn't you do it? So I'll turn it over to Vicki, and off you go. And hope to see you all tomorrow.
Janet, did you see a question or two that Professor Ed ought to address before I do any wrap up?
Well, the most common question, of course, Vicki, was how to get access to the slides. So shout out to Ed for some great slides and a great lecture. I don't know that all of you can see the chat box. I imagine you can, but you do need to email Vicki, VMARIS @ND, that's for Notre Dame.edu, and she will send you the slides. Our second question is also for you, Vicki.
Okay.
But we had a listener that wanted to know about CPE.
Okay.
So it's in the Q&A. I don't know if you want to respond to him personally.
I'd
And
be
then
happy to do that.
Ed,
Yeah.
or both of us, I think, Rob brought up, what is the most common financial mistake made by non-financial managers that you have seen? So I asked Rob if he'd be around tomorrow, but he didn't get back with me yet. So since we do have a few minutes, my guess would be kind of mixing up cash and revenues. But
Absolutely.
do you want to respond from an auditing standpoint, Ed?
I'll tell you what, I guess I would take a look at one consideration was going to be time period. So really what transactions occurs in specific time periods, okay? Because, you're going to put together financial statements. So let's say you put together monthly financial statements. So you have to take a look at what transactions occurred during, let's say, the month of May. What were the expenses against the month of May? And, Rob, when you take a look at it, that's why if you take a look at your receipt when you go buy something, it has a date on it. Because not only did this transaction occur, but when did it occur? In what month do we have to record it? Okay, so I think that's always an issue as when is something going to be recorded. I also think, did you record all the transactions? I used to run the financial accounting system at Notre Dame, and we used to have to say that every transaction had to be recorded at the end of the time period, not 99%. Okay, not 99 point, well, I don't know what my free soap is. What is it, Jan? 99.4% or something. 100% of the transactions have to be recorded. If it occurred during a time period, you got to record it. And I think that's going to be a common mistake or a problem that non-financial people have to take a look at is, did you get the transactions in the right period? And second thing, did you get all the transactions in?
And to reiterate Ed's point, that's all of this cash versus the accrual aspect of expenses. Have you recorded all the expenses that you have incurred, whether or not you've paid them? So that time period is really, really important.
Did that wrap up the questions, Janet?
Well, and now I've got questions coming in now that
Okay.
the lecture's over. So I don't know how we're doing for time.
We are.
Ed, we've got one question on the best indicator of a healthy institution.
Oh.
And also, how does finance work in the hospitality industry? So, Michael, I don't know if you're going to be around tomorrow. Perhaps that is best kind of reserved for tomorrow if we want to get industry specific. But I'm guessing, Ed, we could kind of look at.
I could do best indicator, Jan. I could do best indicator real quick. I'll tell you, it's going to be cash flow from operations.
Correct.
That's absolutely the most important thing. Are you generating enough cash on a continual basis to stay open? You've always heard the term "cash is king," and it really is. And that's probably the best indicator of the health of an organization. If I'm a banker, and whenever you have an audit, if you did an audit for a small business, you always put the audit together, assuming that the next day it's going to be on the banker's desk. And that's probably one thing they're going to take a look at is, how are you generating enough cash? Can you repay me? Can you pay your bills? Boy, that's the number one thing. And if an institution that runs into problems, I'm going to use an example. Liz Claiborne, a couple of years ago, ran into a situation where they almost went bankrupt. And what they did is reformatted everything. And their financial statement said, we are going to focus in on cash, and we are going to conserve cash as much as possible. They did the oldest routine on cash management: collect cash as fast as possible, pay as slow as possible. There's, in a nutshell, Rob.
Thank you, Ed. Thank you, Janet. I so appreciate your time, and on behalf of everybody that was here on the webinar and everybody who will be watching the replay of the webinar at some point in the future, we sure appreciate you sharing your expertise. Several of you have asked questions. I will have the slides available. If you want to send me an email, I can send those out to you. If you are interested in being a part of the video chat tomorrow, which will be a smaller group of people, and want to bring a couple of your questions to that chat, you are more than welcome. Also send me an email and I'll send you the meeting access for that. We've had a couple people who are interested in whether or not there is continuing education units available. If you are enrolled in the module, there are, and we can make that happen for you between now and the next 24 hours or so. We'd want you to participate today and tomorrow, and also next Wednesday and Thursday. And then we also, if you do enroll at this point, we also would make it available so that the next time we offer this module on the campus in the 2-day format, that you would get an invitation to participate with us on campus as part of your enrollment. So that's how, one of the ways we're trying to kind of work with you and have some flexibility about all the things that are happening in our world right now, and as things are evolving with changes related to the pandemic. So we appreciate your flexibility and patience in all of that. But I'll be happy to get on a phone call or email and respond to your questions more specifically if you'd like. Ed, Janet, thank you. We will see you tomorrow.